The MLP market year to date has been sort of a tale of two separate things going on. So if you looked at the stocks, MLP stocks have been broadly flat for the year, maybe up a little bit, down a little bit, but generally in line. But if you look below the surface at the companies, there's actually really continues to be a tremendous amount of activity going on at the company levels. And I think as everybody's more and more aware every day, there's this revolution going on in the U.S. energy patch from shale. And it's leading to increasing volumes of oil production and gas production, and really leading a renaissance in the U.S. energy space. So from a stock perspective, while stocks have been flat and maybe seem ho-hum, the growth and the build-out of energy infrastructure continues apace, very robust, very exciting. So we find ourselves today where, the stocks seem to, be fairly ho-hum, but the underlying dynamics are really powerful and supportive of MLPs. We continue to be very constructive on MLPs, and we're constructive on MLPs at a couple different levels. So the first is, from an investment merits perspective, MLPs today continue to have very attractive financial characteristics for the investor. There's no assurances, obviously, but from what we see in backlog at these companies and for the industry overall, we think there's a likelihood of distribution growth. We're also excited when we look beneath that, just at the fundamentals. Given the shale revolution in the United States and really renaissance in the U.S. energy industry, we think that the fundamentals support strong growth in MLPs for many years to come. So we feel very good about that. And the momentum MLPs had amongst investors was unparalleled. I mean, it was a very hot asset class that had done very well and people were very excited about. What we've seen in the last, I'd say, probably 12 months is that MLPs are sort of digesting some of that, or sort of in a taking a pause as people catch up with where we are today. And so, it's interesting. The MLPs, I've had some clients or investors say, MLPs weren't so exciting in 2013, and MLPs were up well north of 20% in 2013, which is a fabulous year. It only, people seem underwhelmed by it because the stock market was up north of 30. So just a few years ago, there would have been 75 MLPs with a market cap for the industry of less than $300 billion. And today there's more than 100 MLPs and the market cap is north of $500 billion. So we really just see it sort of as a pause along the way. There's been so much enthusiasm for MLPs, but we continue to see a very strong story fundamentally for quite some time. No investment is obviously without risks, and MLPs are part of it. So yeah, of course there's things that we consider as being risks for MLPs. None of them seem very pressing or overly worrisome at this point, but there are certainly things on our radar. So the things that are on our radar would be, number one, it's always a concern about political risk. What if Washington changed the tax rules around MLPs? We actually see no indication of that today, and in fact quite the opposite. There's some talk about growing the MLP category by including renewable energy. So right now, renewables are not allowed to be MLPs, and we're talking about increasing the scope of MLPs so that renewables fit in there. So political is always a theoretical risk, but we don't see that being likely today. Some of the things that are risks elsewhere actually make us feel good about MLPs. So for example, when we look at broader markets more globally, we worry about a lot of the things going on around the world, whether it's the Ukraine or slowdown in China or what have you, but many of those things actually reinforce the strength of MLPs, which is MLPs are really a U.S.-based story. And so even with a slowdown globally, we don't see that being a big issue. The concerns that are probably more pressing for MLPs will be more at the forefront. A lot of people worry about how MLP securities will trade in a rising rate environment. They think people have been buying these for income, and as rates rise, maybe they'll not favor MLPs as much and sell them and swap into other areas. We think that's a small risk, but we're really not too concerned. And I think the biggest risk to MLPs, or one of the big risks to MLPs, would be MLPs pay out a substantial majority of their cash flow each year, and they're dependent upon the capital markets to finance their growth. So if they want to build a large new pipeline, they need to raise some equity in the markets and they need to raise some debt. In order to do that, they need the capital markets to be open, functioning, healthy. During the financial crisis, the capital markets were closed, and that restricted the ability for MLPs to grow. So if the markets were to, take a turn down and investor sentiment, diminished, it could, on the margin, make it more expensive for MLPs to finance their growth programs. A big question we get from investors all the time is how will MLPs perform in a rising rate environment? And this is a logical question for any investor to ask about any investment, but particularly to ask about income investments, because what we find is that, for example, at one extreme would be a bond portfolio. If you own a portfolio of long-term bonds, a rising rate environment is a negative backdrop for that. And you don't, in a rising rate environment, all else being equal, you don't want to have a portfolio of long-term bonds. And what you want actually is in a rising rate environment, you want investments to have growth, because that growth can be an offset to that rising rate pressure. One of the things we like about MLPs as income investments is that they are not bonds. They're not just fixed income instruments. MLPs have historically had nice growth rates on their cash flows. So if we look back over the last several years, MLPs have grown their distributions at a 5, 6, 7, 8% rate. So again, rising rates are not good for any investment. No investor likes rising rates, but MLPs we think should hold up pretty well in a rising rate environment. This is a question we hear a lot about what are the impacts of, so much of the growth in MLPs is predicated on fracking and the exploitation of shale energy, and both what are the environmental impacts of that and what are the potential economic impacts from these environmental considerations. And this is an important thing for people to understand. As I think most people are aware, the big energy renaissance going on in the United States is being driven by the exploitation of shale resources, and part and parcel with that is fracking. And what I think it's important people understand is fracking is not new. We've been doing it for a long time. We are doing it on a bigger scale than we have in the past, but it's a technology that's really been used for decades to help grow production. The second thing that I think is really important for people to understand is that is what I like to think of or talk about as the trade-offs in energy consumption. And so what we're seeing right now is that with the growth in shale production in the United States, the production of natural gas in the United States is growing dramatically. And that's actually a big positive for the environment, because what a lot of people don't realize is that that growing natural gas production is allowing the United States to reduce its dependence on coal. And I think a lot of people don't realize that up until very recently, 50% of the electricity in the country came from burning coal. Coal is very dirty, both from a pollution perspective and from a CO2 perspective. So the growing production of gas is enabling us to phase out or reduce our reliance on coal, and that's actually had some big positives. So one very important or interesting thing is that in 2013, the United States was the only country in the world that saw its greenhouse emissions go down. And this is a really interesting thing because, this is going back in the environmental history books, but the Kyoto Protocol was a global agreement to reduce greenhouse gases, and the United States didn't participate. And in fact, we actually haven't really had much of a policy about carbon, whereas many other countries in the world are trying to reduce their usage of carbon or their emissions of CO2. And yet, the market system in the United States, by leading to increased production of natural gas and increased consumption of natural gas, has actually resulted in the United States being the only country in the world with declining CO2 production. So there's some offsets, certainly, or potential offsets. People have concerns about fracking. The first thing, again, I'd say is this is not new. We've been doing it for a long time. And the second thing is you have to keep in mind whatever your concerns are. It's enabling us to reduce our reliance on coal, and that's really a huge positive for the environment. Many people have been wondering if there could actually be an opportunity for the U.S. oil and gas industry, given what's going on in the Ukraine. And the quick backdrop here is that Europe relies on Russia for much of its natural gas consumption, or much of its natural gas supply. And with what's happened in Ukraine, it makes people more concerned about being so dependent upon Russia. So there's a question of, well, should Europe diversify its sources of natural gas? And one of the things people are talking about is the ability for the U.S. to export natural gas to Europe, so that we can sort of give them another supply source. And we're actually seeing in Congress right now, several Congress people are trying to speed up the approval process for building LNG export facilities. We don't see this as being a big near-term positive for the industry. And simply the reason is, number one, who knows what will happen in Washington, whether or not these approvals will be expedited. But even if they were all expedited, and granted very quickly, it takes many years to build an LNG export facility. So it takes actually 4, 5, 6 years to build one of these things. So any sort of impact from that would be, not until the 2020 timeframe, really farther out than we think is really relevant for our investment horizon.